taxes are going to be your largest expense in retirement, and the combination of taxes, inflation, and hidden investment fees are silently killing your portfolio.
In today's episode, we're going to talk about the investments you should use to help lower your taxes, all the way to the types of accounts you should use. We're also going to explore how to lower those fees and fight off inflation.
Not only will your lifetime tax bill go down, but your investment performance will go up as a result. A true win-win.
Let's jump in.
Hi, I'm Brad, host of the Retirement Planning Podcast, here with my man, Matt Callahan. And in today's episode, we're going to help you master tax-efficient investing. So one of the reasons why people are paying way too much in taxes, or more than they should at least, is because they're using investment strategies that are so outdated, it's almost the way of the dinosaur. What I mean by that is people are still using actively managed mutual funds, which was really popular in the 90s and the 2000s, and still today in most of your 401k plans, you still have actively managed mutual funds. The investing landscape has evolved and improved so much over the last 10 to 15 years, and I really think the conversation needs to start right there. So Matt, walk us through, why is using an exchange-traded fund, or an ETF, why is that more tax efficient than the old school actively managed mutual fund?
Yeah, great question. So a big difference between mutual funds and exchange-traded funds is that, as you mentioned, the mutual funds have active managers, and so they're buying and selling securities within that portfolio on your behalf. And so you may not even sell anything, but if they're buying and selling in that portfolio, those taxes get pushed down to you.
Yeah, you get the 1099 in February,
right?
Going, I didn't sell anything.
What gives? Like, I didn't sell anything.
Why did my tax bill go up?
So as opposed to mutual funds, the passive exchange traded funds, they're not churning inside there, so they're more tax efficient for you.
Right. So in your taxable accounts, that's the huge pickup right there. And I'd say most people we talk to, they have no idea if they have mutual funds or exchange traded funds. And I think that's the first place to start, is look inside of your investment portfolio and figure out, what do you own?
Exactly. And I mean, one of the things you want to look for, we call this the hidden cost in mutual funds and exchange traded funds. So ETFs, they have these hidden costs as well.
Right.
But the expense ratio, you may want to consider some of these mutual funds we see, 0.75% as an average cost, when we can see an average cost of an exchange traded fund being closer to 0.15, 0.09, or
0.04
right, on
super low.
S&P. Yeah. And so by having these lower fees, I mean, that if it's higher, I mean, that's dollars that are getting stripped right off of your rate of return. And so if we could just change a mutual fund to an exchange traded fund, that could put more dollars in your pocket for your retirement.
Yeah, when I first got in the industry, I remember that the internal expense ratios, some of them were north of 1%. And think of it this way, it's like going out for a run and you're running literally into a headwind. And so you're having to create more energy. Well, it's that headwind that acts as the drag on your investment performance. So the lower you can keep that internal expense, the better. And that's another reason why we really prefer ETFs.
And I would point out something. I'm not here to say that cheaper is better, or active managers in some case aren't good, but I just want you to be aware out there that there are things to consider that could help you be set up for better success.
Absolutely. But in those taxable accounts, the tax efficiency of those ETFs is a huge pickup when it comes to lowering that tax bill.
Yeah.
Okay. So another strategy that can really help with tax efficient investing and lowering the tax bill is tax loss harvesting. Can you explain how that works?
Yeah. So tax loss harvesting, we're focusing on your taxable investment accounts. And what this does is it allows you to take advantage of the market volatility. So as we all know, markets go up and down, right? And we always coach our clients, hey, don't sell your investments while they're down. Let's wait through.
Buy low, sell high.
Buy low, sell high. But in this case, we would recommend taking a look to see if it makes sense to sell on the downside and lock in those losses. But you need to do something simultaneously. You need to sell an investment, and then you need to replace that investment with something very similar.
So it participates in the recovery.
Right. Markets tend to come back after the downturn, so you still get to participate on the up, but you got to lock in those losses to be used in the future.
Now, you just got to be careful to avoid the wash sale rules. So how do we do that correctly?
So what Brad's talking about is you can't put in a 500 index fund and replace it with another 500 index fund. They have to be different enough to not cause this wash sale rule, which could eliminate the losses that you locked in.
Right. So in order to illustrate the powerful impact of tax loss harvesting, we're going to show you a case study. So we're going to take you to Sam and Wendy, clients, made up, of course, fictitious for confidentiality purposes, but we're going to take you back to 2022, the bear market, when the S&P 500 was down 25% at its low in October of 22. And at that moment in time, we realized $444,000 of losses we basically sold investments when they were down. We immediately replaced them with similar investments. And at the time, I'll never forget it, the client's CPA thought we were nuts. In fact, she thought we were idiots.
Yeah, she came at us and said, why would you ever do this? These clients are never going to be able to use these losses. So basically, yeah, like Brad said, calling us idiots on this case.
But now who's getting the effect? We're all laughing about it now because she's fully on board, because the investments that we put in as a replacement, not only have they come roaring back and they're now higher than they were back in 2022, but now Sam and Wendy have $444,000 of losses that they can do two things with. They can reduce their adjusted gross income by $3,000 per year for the rest of their life.
So they don't expire.
They don't expire ever and forever. But for them, the more powerful thing is they can now sell gains all the way up to $444,000 of gains and pay nothing in taxes. So how did that strategy work out as Eve kind of set up their financial plan?
Yeah, great question. So we look in 2022 here, and we were able to realize $40,709 of gains and not pay any taxes on that.
Right.
So if you look forward here, now we're able to roll forward about $400,000 of losses. And what this is allowing us to do is take advantage of large Roth conversions and still being able to realize these long-term capital gains at 0%. So very, very powerful tool to take advantage of the tax loss harvesting.
Absolutely. Now, on the flip side, we just talked about tax loss harvesting. What about tax gain harvesting? What does that mean?
Great question. So with tax gain harvesting, now we're talking buy low, sell high again. Now, if we have losses that we've harvested over the years, maybe now our portfolio is doing really well and we want to take an extra vacation or just an unexpected expense pops up, you can sell now your gains and use those losses to offset the gains in the future. Another way to look at it is if your portfolio is starting to become over-concentrated, you may want to take some of those gains off the table and then redeploy them in your portfolio to balance out that risk.
Perfect. Okay. Another way to illustrate the powerful impact of tax gain harvesting is to look at a case study where we had clients who were taking IRA distributions, they had Social Security income, and their total income was just a little south of $80,000. And so in a scenario like this is Peter and Sally, and Peter and Sally found themselves in the 12% tax bracket. So what we did, anytime we see someone in the 12% tax bracket, we know that they can realize capital gains and pay nothing in taxes. This is the opportunity that presented itself for Peter and Sally. They're in the 0% capital gains bracket, and they had room to run until all of a sudden 0 goes to 15% for them at the $94,000 mark. So what we did is we solved for max. We went into their tax planning projection. We solved for max to find out how much could they realize in gains and pay nothing in taxes. So for Peter and Sally, what we saw was that they could literally sell $26,000 of gains and still be in that 12% bracket, which means they pay 0 in long-term capital gains tax. So they were able to sell quite a bit of gains and pay nothing in taxes just because they know the rules and they know how to use them in their financial planning.
And this could be very beneficial if you have highly concentrated stock. Maybe you bought the Magnificent Seven and it worked out for you, but now you're able to realize those gains and not have to pay the taxes and either take it as cash or redeploy in a diversified portfolio. But a lot of good things can come out of it.
Right, exactly. We have an old saying that you want to pay your fair share to the IRS, but you never want to leave them a tip. In that example that you talked about earlier of helping your client to do $100,000 Roth conversions, what is the benefit of doing those Roth conversions?
All of these things were a perfect storm for them because we were able to take advantage of those, the tax loss harvesting and then do Roth conversions. And so with Roth conversions in a down market, you're actually able to convert more, pay less taxes, and then all the dollars will go into that Roth conversion or into the Roth IRA. And what this can do is lower your tax bill for your lifetime, but then also allow you to transfer tax-free wealth.
Right.
So you'll notice all these blue bar graph charts here. They're relatively low in the beginning years of retirement. And then as time goes on, you can see a little spike when they're turning on Social Security and then a bigger spike further into the future. These are their required minimum distributions. And so why this is a tax play is because we want to reduce some of those required distributions in the future because it's really creating a lot of taxes for them. And in this scenario, over their lifetime, a tax bill of $3.2 million.
$3.2 million in taxes.
Right.
They're very middle class. Yeah. They're normal.
And so we call these the gap years of the year they retire all the way until they take required minimum distributions. And we want to see the number of what can we convert from those IRAs or 401ks into Roth IRAs to see if that has any benefit for them. And so by taking advantage and implementing these Roth conversions, you can see we lowered their tax bill down to $2.4 million over their lifetime, which is a decrease in about $802,000. I mean, Brad, these are real dollars. That's a good chunk of change.
$8,000 less in taxes.
So, and in addition to that, their liquid net worth is increasing too by $595,000. I mean, this overall plan is great for what their goals and objectives that they're trying to accomplish.
Are these strategies even legal, man?
They are legal 100%. And the reason being, the IRS, they want you to convert your IRAs and your 401ks because they're getting their tax dollars today. It's an upfront tip for them if you're doing these conversions. Yeah. And they're wanting you to make mistakes. I mean, you're able to do as little or as much as you want of a conversion. And don't be the fool that converts the full account and bumps you up into a higher tax bracket that could cause your capital gains taxes to be 15 or 20%. Net investment tax you could run in. Medicare surcharges. It really has a ripple effect on everything that you do with these decisions. And you really want to just be methodical and work with your financial advisor and the CPA concurrently to make your plan come.
Know the rules, have a plan, have a strategy, and use the rules correctly. And you can save a ton of money on taxes and improve the outcomes. All right. So Matt, what's the difference between ordinary income tax rates and capital gains rates, and why should someone know that?
So your ordinary income rates are on your marginal tax bracket. This can be 10, 12, 22, 24, up to 37%. And this determines how your income is being taxed. So anything that's counted as earned income. So as opposed to your capital gains rates, which are typically more favorable, those are coming in at 0, 15, or 20%. Okay. And so there's short-term and long-term capital gains rates.
Which one's better?
Long-term capital gains rates are typically better because your short-term gains are taxed at your ordinary income rates. And so the way to get long-term capital gains, it's a weird rule, but it's 12 months and a day.
You got to own the investment for 12
months and a day. Yeah. So if you're looking to do some tax gain harvesting or just looking to realize some gains, make sure that you're looking at the different lots of your investments to make sure that they have gone long-term if that's what you're trying to accomplish.
Right. And then talk to me about dividends. So we've got qualified dividends versus ordinary dividends. What are they? Which one's better?
So ordinary dividends are taxed at your ordinary income rates. And so you may want to consider having a higher percentage of qualified dividends in your portfolio.
Right.
These are taxed at your ordinary income, at your capital gains rates. And so they can be more tax advantageous for you.
Right.
And we always get questions, well, if that's true, if I can get 0, 15, or 20% qualified dividends, let's just load up on those. We may not want to do that because the way you get qualified dividends is they are large U.S. companies, which we love large U.S. companies, but we're giving up an extra layer of diversification if you're only focusing on those qualified dividends.
Right. So about 70% of your dividends being in considered qualified dividends is a great place to land, which means 30%. It does add that diversification. In any case, we think that's the best overall strategy when looking at that. All right. So let's talk about tax-free muni bonds for a minute. And so tax-free municipal bonds, these are bonds at the state or federal, through state or federal agencies, and they can be state and or tax-free depending upon where these bonds are at. Where does that fit in a portfolio?
Yeah, if you have taxable investment accounts, you may want to consider putting these municipal bonds in there. And as you mentioned, there could be, you get federal, state tax exemption from there. But if you buy a state-specific municipal bond, then it could be state tax-free too. You want to consider what your ordinary income tax bracket is, because if you're in a low tax bracket, it may not be advantageous to use these tax-free muni bonds.
Why is that?
They usually pay less interest than your taxable bonds, and so you just need to compare and contrast. Does it make sense if I'm in a low tax bracket to pay taxes on those, or I'm in a higher tax bracket and I need that tax-free income?
Right. So for a high income earner or a higher bracket, the tax-free bonds can usually make a lot of sense.
Right.
But 22% bracket, 12%, that's kind of great.
I would probably steer clear, just stick with the corporate.
Because you're getting less yield,
Yeah.
less income, right? Now, don't be surprised, though, when you have income from your tax-free bonds, it does go into calculating provisional income, which has to do with the taxation of your Social Security benefit. So they do take, even though it's tax-free muni income and it's tax-free on the 1040, it does count for that provisional income, which can impact how much you pay in taxes on Social Security. So
if it's too good to be true, there's always got to be a catch.
There's always a downside, right? And, financial planning, there's so many things. It's the ripple effect. It's all interrelated anyways, but it just highlights, you got to know the rules. You got to have a strategy. You got to have a plan. All right, so as you can see, there's so many factors that go into creating better outcomes in your investment portfolio, but using the right investment vehicles, having a good strategy around taking advantage of market volatility, tax loss harvesting, also tax gain harvesting, doing Roth conversions, these are all things that can lead to a more efficient, effective investment outcome. Hey, so Matt, the last thing I want to cover here is what types of accounts should people be investing in to create more tax efficiency?
Yeah, great question. So there's really 3 different buckets you can put your dollars in. Your taxable investment account, it's going to be triple tax disadvantaged, meaning that you're taxed when you get these dollars. They're taxed when they grow in these accounts if dividends or income are pumped out. And then they're taxed when you sell or spend these accounts. And you're probably thinking, well, why would I put any dollars in that type of account? These usually come with the ability to tap into it. They're more liquid.
Flexibility.
You can get in there without a fee or expenses typically. But then we have your IRAs. These are great because you can get a tax deduction up front. They grow tax deferred. You're not paying taxes as they're growing in these accounts, but then they're totally taxable at your ordinary income rates at retirement.
And they have required minimum distribution.
Right.
And so the IRS loves that.
And 59.5, we've heard that rule that you can't tap in without a 10% penalty.
Right.
And then we've got the Roth bucket. You don't get a tax deduction up front, but like the IRAs, they get tax deferred growth and then come out tax-free in retirement. So you'll love these dollars in retirement.
And that's a wonderful bucket to give to the kids as well to build a tax-free legacy for them. What about the fourth kind, the health savings account?
He's talking about secret bucket number 4. So we talked about that. The taxable account is triple tax disadvantaged. Right. The HSA actually gives you triple tax
the only one of its kind.
Right. You get a tax deduction as you put dollars in these accounts. They grow tax deferred. And if you use these dollars for qualified medical expenses, they come out tax-free as well.
Right.
And some people will come to us and say, you know what? I don't want to put a lot of dollars into my HSA because I'm going to be the lucky one, not have any medical expenses. So I'm just going to not contribute to that. The beauty of this account is that you can actually take dollars out for whatever you want at age 65 with no penalty.
Right.
Yeah.
So I think the key is understanding the different kinds of investment accounts that are out there for you. we like to implement a strategy known as asset location, which means take your more tax-efficient investments like the ETFs, in particular large U.S. company ETFs, put those types of investments in the investment account that's most exposed to taxes, which would be your taxable account, your trust, or your brokerage account. Then you can take your tax-inefficient investments, so your REITs or anything that pays dividends that are ordinary dividends like bonds, those kinds of things, you could put those in your IRAs because those are tax sheltered. So asset location allows you to, again, know the rules, have a strategy, have a plan, and keep the tax bill lower by just understanding how it all works. So with that, you can see there's a lot that goes into optimizing your investments and mastering tax efficient investing. And so from having the right investment vehicles in the portfolio to having the right accounts in your portfolio, you really want to think it through. You also want to be paying attention in tax loss harvesting. When the market gives you lemons, make lemonade. Tax gain harvesting when you're in lower brackets. There's a lot of work that goes into this. Well, Matt, we covered a lot of ground today. I mean, from the different kind of investments to use, to the different investment vehicles, to when you should tax loss harvest versus tax gain harvest. We touched on Roth conversions. I mean, there's so much that goes into optimizing your outcome and really mastering tax efficient investing. So anything else for the listener in closing?
This is where it just gets really complicated and where we love and do our best work. So yeah, if anyone wants to talk to us, just let us know. We're here.
Happy to help. Yeah, well, this was a good one, and we look forward to seeing you on the next episode.